Alright, listen up. This might be the most important video you watch all year. Why? Well, because the biggest debate raging around crypto Twitter right now is whether or not Bitcoin's 4-year cycle will continue to hold. And that question matters a lot. Because if this cycle holds, then we're near the end of it, and you should probably sell soon. But if it doesn't hold, then the old playbook goes out the window, and selling now could be one of the biggest mistakes you make all cycle. After all, if you sell too early and prices keep going up, you'll probably FOMO back in at the actual top, and then boom, you're wrecked. You don't want that. I don't want that. That's why today we're gonna break down both sides of this debate. And by the end of this video, you'll have a full enough picture to make up your own mind and adjust your plan accordingly. Alright, but before we get into all the nitty gritty, let's just make sure we're on the same page here regarding this whole 4-year cycle and why some people swear by it. So first of all, Bitcoin was designed to get scarcer over time. Every 210,000 blocks, which is roughly every 4 years, there's this thing called a halving event. And that just means that miners suddenly earn half as much Bitcoin for doing the exact same work. So overnight, the amount of new Bitcoin hitting the market gets cut in half. And that's a big deal because miners are one of the biggest natural sellers of Bitcoin out there. Like, they gotta sell to pay their bills, electricity, hardware, staff, all that. So when their rewards get slashed, it means there's less new Bitcoin being sold on the open market every single day. And that's what people mean when they talk about a supply shock. Because if the supply suddenly drops, then there's only one place for prices to go: up. It's simple supply and demand. But that's really just where the story begins. Because once the price starts ticking up, the whole energy shifts. People who tuned out suddenly start checking charts again. Headlines pop back up on CNBC, influencers start posting, and that same optimism that fueled the last bull run starts spreading again. Then the momentum really hits, and it's like tossing a match into a room full of gas. Everyone's chasing green candles, the price rockets, and before long, it's a full-blown frenzy. That's the point where everyone feels like a genius, and it starts to feel like Bitcoin can only go up. But as we all know, the market can't keep going up forever. Eventually people take profits, the price rolls over, and that excitement quickly turns into fear. That's when the tourists start to leave and we enter the quiet part of the cycle, the accumulation phase. At that point, only the true believers remain, stacking slowly, paycheck by paycheck, quietly building the foundation for the next cycle. So when you zoom out, you start to see a clear pattern here: halving, pump, crash, reset, over and over again throughout Bitcoin's history. But also, if you just pull up a Bitcoin chart and draw a vertical line at each halving, you'll see something quite interesting. Because those halvings pretty much mark the start of every major bull run, each one followed by the same pattern over and over again. And that's why people believe in this theory so much, because it's simple, it makes sense, and it's worked every single time. That's why a lot of people exclusively trade around it. After all, if the pattern keeps holding, why not follow it, right? But if it breaks, then everything changes. And that's exactly what we need to talk about, because when you really dig into the facts, the stats, and the data, a different picture starts to emerge. You see, people love to ask, is this time really different? But what if I told you it's already been different throughout this whole cycle? For example, for the first time ever, Bitcoin hit a new all-time high before the halving event. That alone should tell you that something's off. Because in every prior cycle, it was the halving that kicked off the bull run. But this time, the rally came months in advance. And ever since then, people have been trying to explain it away with all these new terms like left translated cycle, lengthening cycle, whatever, right? But to me, that's just mental gymnastics to keep the 4-year theory alive. And maybe the simpler answer is, it's just not happening anymore. Now, that's not all by any stretch. I have like 5 other reasons for why the 4-year cycle is broken. But before we get there, I want to share with you real quick something super interesting that I've been using lately. It's a newer exchange called Blowfin, and I feel like not enough people are talking about it yet. They've got over 500 futures pairs and 400 spot pairs, and the liquidity is actually really solid. It's globally accessible, KYC optional, and it just feels smooth to trade on. What makes it stand out for me though are two things in particular. First, USDC perp pairs, which makes it convenient for those of us who hold USDC. Second, they've got X stocks, aka tokenized versions of major stocks like Apple, Tesla, and Amazon, which means you can trade those right from your crypto account. And then they also check all the security boxes like Fireblocks, Chainalysis, and a proof of reserves that's fully public on Nansen so you can verify it for yourself. Anyhow, if any of that sounds enticing to you, then just sign up using my link below so you can get up to $300 in deposit bonuses. Alright, back to the case against the 4-year cycle. And here's the thing, the halving itself doesn't move the needle like it used to. In the early days, Bitcoin's inflation rate dropped from around 30% to 15%, and that was a big change. But now, after the 2024 halving, it went from like 1.7% to 0.8%, which is barely anything. Also, on top of that, miners just don't sell enough Bitcoin for it to really make a difference these days. Like, the amount they sell is tiny compared to the overall daily trading volume, which is in the tens of billions of dollars. So that old supply shock that used to cause the bull runs, well, these days it's basically a blip on the radar. But even beyond that, the market itself has completely changed. Like back in 2013 or 2017, it was mostly retail traders and OG whales playing the game. But now, you've got a whole new class of players. I'm talking institutions, corporations, hedge funds, and even nation states buying Bitcoin. And if you think about it, these are long-term allocators. They don't care about no rainbow chart or 4-year cycle. No, they make moves based on macro conditions, not on crypto Twitter's opinion or emotions. And that's why I think this whole self-fulfilling prophecy of the 4-year cycle is starting to fade as well. Because all these new players don't think like we do. They're not chasing hype, they're just quietly buying, holding, and hedging. And speaking of hedging, that's another huge point I want to make here. You see, we've now got paper Bitcoin everywhere. ETFs, futures, options, perps, you name it. And that means a massive chunk of Bitcoin trading never even touches the blockchain. So all that on-chain data that used to be amazing for predicting cycle tops, well, it's way less reliable now. And if you think about it, all of this has turned Bitcoin into something new. Like, it's kind of crossed over into the TradFi space, right? Which means you could argue that it trades more like a stock these days, aka moving with interest rates, liquidity, and macro conditions, instead of its own internal halving schedule. But then, let's be honest here. The 4-year cycle has only played out 3 times in Bitcoin's history. 3. If it had happened like 50 times, then sure, maybe that would mean something. But 3? That could literally be random chance when you're talking about statistics. And here's a real twist for you. What if it was never even the halvings that were driving Bitcoin's price? Like, what if it was always global liquidity cycles doing the heavy lifting, and the 4-year pattern just happened to line up by chance? Because check this out, when you overlay Bitcoin's price with global liquidity or rate cut cycles, it kind of matches up. We see that every major bull run has started after liquidity flooded back into the system. So maybe what we've been calling a 4-year cycle was really just a reflection of global liquidity all along. And now that institutions, corporations, even governments have joined the party, Bitcoin's pulse is more connected with the broader economy instead of its own internal clock. So yeah, when you take a step back and look at all this, it's hard to make the case that the 4-year cycle will continue to hold. But I'm not done yet. Here's another twist for you. Even if the 4-year cycle is broken, it might still look like it's happening one more time. You see, if you zoom out and look at the big picture, not just crypto, but the entire macro environment, things are starting to line up in a strange way. You've got liquidity flowing, most asset classes are at all-time highs, and sentiment is insanely bullish across the board. However, a lot of top macro guys that I follow are saying the same thing, that we're due for a major correction soon. Maybe not a 2008 style crash, but at least a notable pullback. Something to cool things down and reset the excess. But here's where it gets interesting though, because Bitcoin usually front runs these kinds of macro turns. It tends to peak before the broader market because it's basically the purest risk asset on planet Earth. So if stocks are due for a correction in the next few months, then that timing could still line up with when the 4-year cycle would have topped anyway. And if that happens, it's gonna look like the cycle held up yet again, even when it was just really macro liquidity doing its thing behind the scenes. But anyhow, with all that being said, here's where I'm at with this whole debate. Personally, I don't think the 4-year cycle holds anymore, at least not in the clean, predictable way that it used to. But I do think that price action could still be close enough that people will keep on believing. And if we get one more leg up that lines up with the usual cycle top timing, then that's where I'll start to turn defensive. I'm not gonna try to time the exact top, but I wanna be ready for either scenario, right? Because whether it's the halving or macro liquidity driving things now, it really feels like we're getting close to a top either way. But yeah, at the end of the day, the takeaway here is simple. This market keeps on changing. It's not like the old days when there were only like 300 coins and you could throw a dart and get a 10x easily. No, these days it takes real research, analysis, and strategy to win. And that's exactly why we've built Retail DAO, to help retail investors succeed through coordination. Because when retail works together, we can uncover better insights, spot better opportunities, and build way more influence than any of us could alone. So if that idea resonates with you, come join us. Links below in the description.